Hello and welcome to Pairs of Aces. I'm your host Adam Lemon, and joining me today are my co-hosts, DailyForex's senior analyst Huzefa Hamid and Christopher Lewis. Today we're going to be talking about the American stock market, or the North American stock markets, and the recent correction, the ADP data that came out yesterday and how that affected the market. We're then going to be moving on to the Bank of England's policy meeting, which finished, as at the time of recording, just a few minutes ago, and their decision to hold rates. We're going to be moving on to the US dollar and how that trend is affecting the major pairs. And then we want to talk about an unusual or unorthodox sell signal you can get in trends that we saw in the big increases in value in gold and silver. And then we're going to finish off by talking about a little trading strategy called highest open, lowest open that I picked up on the internet a few days ago and backtested. So welcome to everyone. You can always subscribe to our channel. Please do. That way you won't miss an episode or anything tasty that we've got for you guys. And you can leave comments under the item and we will answer them. You can treat them as questions. We'll answer them in the next episode. So introduction over, moving on to item number one, the stock market. We haven't seen any new highs, but the rally is still there. Still a bull market in the S&P 500 and the NASDAQ 100 and pretty much any other North American index you like. And some global markets are also rallying pretty nicely too. We saw a bit of a dip a few days ago on some concerns about valuations. You know, that's rumbling along in the background, and it's earnings season too. And we saw a few bad numbers, but we seem to have seen a recovery. We got some good US jobs data from the ADP survey yesterday. And now the market's coming back up. It's still off the highs. I'm long, both the S&P and the NASDAQ. What do you guys think, Huzefa? What about you?
You know, we had that big dip on tariff news back in early October 10th, when Trump resurfaced the idea of tariffing China. And I think that when you think about the tariff play, I think that is the one that matters. It's the relationship between US and China. Other relationships matter, but not to that extent. So anything that involves China, any good news or bad news, I think in terms of tariffs, that'll affect the market. But it took this big wild dip, broke out this. You don't see gaps in the S&P 500 very often, but it gapped up to a new high. As expected, from a technical perspective, you're going to get some kind of a pullback. And I think that's all we've seen is a pullback to the previous high, like a support resistance or resistance break, retesting it as support. So I'm still long. You know, the way I look at my trends is for an uptrend, rising supports. And that's really all we've seen. So from a technical perspective, the data's coming out and it's just kind of feeding into those waves.
What about, would you look to get out below a certain level? Is there a significant level for you where you'd start to get nervous?
Oh, 6,500. Yeah,
6,500.
It made that big red daily bar from the October 10th China announcement or China tweet. I don't remember what it was now. There's been so many tweets, so many announcements since. That would be I would start to be a nervous long. I was looking back at the chart, the weekly chart, for 2007, 2008, so credit crisis time. And I mean, from a news perspective, it kind of came out of nowhere. The people that were following it understood the subprime crisis was like bubbling up underneath the surface. But from a public perspective, it's suddenly, you had these banks collapsing seemingly overnight. I know there's a lot that led up to it, but that chart pattern took like about a year to form. It took like a solid, you see it kind of makes this rounded top, almost like a head and shoulders top. I would be very surprised if and when the market, for me, it's more of a when the market does become a bear, it's not going to just decide, oh, we're tied up here, we're going to go down. It's going to take its time shifting that psychology, shifting that sentiment over, and we'll see a nice rounded top. I think it'll take at least 6 months to develop. So we'll have plenty of warning that the trend is over. We'll get a bit of a range, similar to what we've seen in the DXY.
I feel I'm a bit more nervous than you because in recent years we've seen these wild crashes. I'm still very scarred by what we had when the coronavirus hit, although that was exceptional. But it feels to me that in recent years, when markets really do start going down, they go down very rapidly. So that's interesting to me that you think it will top out gradually.
The coronavirus dip, 5 weeks, really quick.
That was
Historically,
exceptional.
yeah, and then but the rebound, it wasn't as quick, but it was quick.
Oh yeah,
yeah. It doesn't even look like a bear market on the chart anymore.
Yeah.
It just looks it just looks like.
That was I compared it to the 1929 crash. I was feeling very apocalyptic about it, and it was actually a faster descent than 1929. So I panicked and liquidated my pension and everything, and that was a mistake I paid for because it came roaring back, and then there was that whole crude oil insanity where it got to a negative price. Those were strange times. Luckily, we're not in those times now. Chris, I don't want to leave you out. You've been sitting here for 6 whole minutes and you haven't really had to say anything.
With the U.S. stock markets, there's a couple things I would say. Number one, I think it goes higher. Now, that's not to say that we don't lose 10% in 3 days, because I think that's just as likely. One of the things that you're talking about, the way the markets have behaved during the coronavirus as opposed to 2008, there's a lot more algorithmic trading now, which causes more downward pressure in a shorter amount of time. You have less people making decisions, so that's why you get these wild crashes. And I think eventually what happens, this is my theory at least, the adults come into the room and go, what's this machine doing? If this keeps going lower, we don't care about this account because we're going to have bigger problems. And then they start to buy, or they say things like, well, IBM is still going to exist in 6 months. So they buy stocks like that. Now, I will split the difference between the two of you. I do agree with Huzefa with the 6,500 area. I don't have a specific number where I would be getting out, but I think you're going to have a pretty significant sharp pullback, a sharp rally early next year, and then maybe a topping pattern. I think we've got one more to squeeze out of this. I also don't short the U.S. indices. I just don't bother. There's no point in it.
Me neither.
The Nasdaq 100 is not 100 stocks. It's 7, and these days it's more like 4. So it's really an ETF. And I tell people all the time, they're like, should I short here? No, just don't ever short. You have a couple options. You can buy puts. They're generally cheap most of the time, or just stay out. Buy it at a lower level. Most people don't understand that these indices are not designed to fall. Otherwise, they would be equally weighted. So NVIDIA being 14% of the market, if NVIDIA, Apple, Tesla, Microsoft are all going higher, if they're having a really good day, it's hard for the index to have a really bad day. It might finish negative, but not by much. So I think a lot of people need to get that out. That's the biggest problem I see with equities traders. I'm thinking more along the lines of futures traders and CFD traders when I say that, but that's one of the big issues. You just don't sell it. It's not designed to fall. That doesn't mean that you always buy. Being on the sidelines is a position as well, and that's a position I found myself in multiple times this year. This has been a very difficult year because you had the runaway momentum, and then you'll get sideways, and then the occasional the other day. The other day was pretty rough. I was literally on with a client on a live stream with a bunch of people and said, well, at least we're out of that whole Trump tweeting thing. And literally 30 seconds later, that's when he did that tweet. It was amazing, like literally 30 seconds later. So this is a market that you want to participate in, but you need to be very cautious with your position size. And there's the retail thought process of, I'm trying to catch the top. You just don't. And I do think volatility is a thing that's going to be here for years, and part of that's algos, part of that's Donald Trump, part of that's economic uncertainty, geopolitics. There's plenty of things to spook the market. So you just have to accept the fact every once in a while it's going to misbehave. But I think ultimately it goes higher. The one thing I am worried about, though, is AI. AI is increasingly becoming not only a bubble, but the math isn't working out for the data centers. I think that's going to be an issue in the future.
Did you see Sam Altman it was like 2 days ago? He was being interviewed, and the podcaster asked him, okay, you've got a 1.4 trillion spend commitment and you've got $13 billion of revenue. That's over 100-fold difference. And this is like, I didn't understand the economics or the upside down economics of AI until that question. And the way Sam Altman reacted, like he was peeved that somebody would have the gall to ask him that question.
They're already
And
starting to hint around of asking for money from the government.
yeah. And there's talk about having to bail these companies out like they're banks and that they're too big to fail. And this is a very different environment.
Yeah, there's going to be a shakeout at some point,
Yeah.
and it's going to be ugly. So that then begs the question. I guess we're already seeing signs that when the inevitable downturn in the stock market comes, it's going to be
ugly.
it's
It's going to be
gonna be rough.
and it's going to be an AI blow up or an AI shakeout, I guess.
But once that happens, you will have plenty of time to accumulate whatever companies, Nvidia, OpenAI. This is going to be like buying Amazon in like 2003. There is going to be one heck of an opportunity once everybody blows up.
I think write down the list as well, and those companies. And I think it will go back to some level of traditional price discovery, value discovery, where you get companies trading like regular companies that make furniture or airplanes or engineering companies or industrials at reasonable PEs. People will look at these companies and think, okay, that's what the equity markets, and you and the three of us were speculators, but that's what the equity markets are for value discovery, for price discovery. And we'll start returning to that some level of normalcy in terms of what the markets are designed to be.
Right. Yeah. Okay. So turning to the Forex markets now, or not exactly the Forex market, but a central bank, which is kind of in the same ballpark. The Bank of England had policy meeting today, and they were expected to hold rates, which they did, but the voting was a little bit tighter than was expected. They only narrowly voted 5-4 to hold the rate, and there has been increasing pressure for rate cut, and the British pound's already been relatively weak. It didn't really go up. I just looked at the charts a few minutes ago, and I see a bit of volatility, but it didn't really react to the vote. Maybe I'm making a bit too much of it, but
very muted reaction.
Yeah, the UK is certainly, maybe it's a bit oversimplistic to see the currency as a share price for currency, but the UK seems to have its share of woes right now. And there's a lot of talk about a kind of stagnant productivity and just a kind of general malaise that harks a bit back to the woes of the 60s and 70s, although it's quite different now. Do you guys have any views on the pound? Do you see it as a weak horse that maybe you can use as a shorting vehicle? Or
I look at the pound dollar. I look at the last 6 months. It's made a textbook topping pattern. It's made this beautiful rounding top, and the sentiment about the UK economy, even societally, I think malaise is a fantastic word, Adam, that you picked up on. I think that's exactly this muted sense of ambivalence, of directionless of the UK economy. They're trying everything they can. They can't solve their way out of it. They can't grow their way out of it. There just isn't that productivity. There isn't the demand for goods. There isn't the trade agreement since leaving the European Union. None of that has really kind of fallen into place. There's a ton of poverty among society. And that's really hamstringing the Chancellor of Exchequer, the finance minister in the UK. And it's showing up in the way the markets have behaved for the last 6 months. It's really topped out. It made a support. It broke the support. The rate decision, the decision is muted. I think it will just test the previous support as resistance. And I think that big chart pattern will speak for itself.
I was actually looking at the chart yesterday, and it looked to me like it could fall quite easily to about 127.
Yeah.
Because that's where it took off from a few months ago. And you know how technically when you get these fast moves and if it goes up quickly, it will come down through the same price area just as quickly. So although it's kind of finding a little support at 130, I could see it falling as low as 127 pretty easily, fairly soon.
Yeah.
Chris, what about you? Any views on the pound?
Well, full disclosure, I've been short of the pound since the day after the FOMC September meeting.
Wow. Okay.
But that's not a pound thing for me. That's a dollar thing, which
Right.
we'll get to in a minute, obviously.
Sure.
But for the pound, my target's 127.50. So it's interesting that you said 127. There's a huge impulsive candlestick somewhere in that neighborhood. I'm just aiming for that. I'm deep in profit at the moment. My stop loss is, I don't know, somewhere a few hundred pips above where we're at. So I'm not overly concerned about it. And in fact, haven't even opened up the charts this morning. I've been short the pound against the dollar, but that was a dollar move. Now, as far as the pound in general is concerned, it's hard not to notice that it's been struggling against the Canadian dollar recently, the Swiss franc. Even the pound yen hasn't performed quite like it typically does when the yen itself is under trouble, under a little bit of duress. So for me, it's just a simple lack of momentum. Now, Huzefa said something about the topping pattern, and he's right. It's now it's very classic, but my decision had nothing to do with the pound originally. I just, sometimes you just get dumb luck in your favor. And that's literally what that trade was. I watched the reaction to the FOMC and I'm like, okay, the dollar's bottomed. And, it wasn't anything against the pound per se. And I remember thinking at the time, because if you think back, even on the way down, and as everything was selling off against the dollar about a year and a half ago, the pound outperformed. It went down less in comparison to many other currencies. So I remember shorting the pound dollar and thinking, this one will probably work, but this is my least exciting one. And, here we are 2 months later almost. So I think it's got further to go as well. I think it's got quite a bit further to go. 127.50 is my target. I'll adjust it as needed. I could see even 125 given enough time. We'll just, once they start cutting, I think once they throw in the towel and start cutting, that might accelerate. We'll just have to see.
Chris, I think there's a lot to be said for a small comment you made in that analysis that you said, that was the least exciting trade. I think sometimes I find in my trading history, it's a sleeper trade. It's the stuff that people aren't looking at, the stuff that's not making headlines. That's the stuff that really pops. It's not the stuff that the shiny, look at me over here thing.
Range-bound traders right now have to love the Aussie dollar, US dollar cross. You want to talk about something that'll put you to sleep. It's trading like the Euro Swissy did a few years back when there was the peg and it was jumping 40 pips in each direction for a year.
Yeah.
The Aussie's been miserable.
I thought it would kind of do something when they got that 3.5% inflation print, because that was a dramatic overshoot. And that really makes cutting impossible. So I thought, okay, maybe that'll do something, but maybe that just tells you about the inherent the latent weakness they've got there, that even ruling out rate cuts.
China, maybe it's part of the US-China thing too.
That's also true. They're very exposed to China.
But unless you're a short-term trader, it's a hard pair to trade right now. It just is.
Adam, was that an overshoot in terms of the consensus?
Yeah, my understanding was the consensus was about 3.1%.
Right.
It would go up from 3 to 3.1, just a little tiny tick up. And it came in at 3.5. I think it was it last week, 2 weeks ago, I think. And, every now and again, I write an analysis of the Aussie against the dollar. And like Chris said, it's boring. And I'm desperately searching for an angle or... like you say, it just goes backwards and forwards.
Horrible to write about that. That's my least favorite market right now.
And it's funny because
I don't even care what.
usually there's a lot of volatility in it, and it doesn't like to trend. It's very unpredictable. If you apply almost any strategy to it, it doesn't really work very well. And I see it as kind of, it's been for a while just this risk barometer, but it's become really uncoupled from stock markets in the last year or two.
I don't even know what it's coupled to at this point. The U.S.-China trade negotiations, maybe, because that's kind of up and down and not really going anywhere one way or the other in a clear pattern. I mean, that might explain it, but beyond that, I don't even know what the Aussie. It used to be gold. It used to be gold and copper and iron and aluminum, and then it used to be Chinese demand, and now it's just, it's like trading bonds almost. It's kind of astonishing, really.
It's interesting how currencies, they're so hot in one way or another, and then you build a whole kind of life around them, and then they just turn into something else. I remember in the early 2010s when the pound just kind of died. It just started doing nothing. It was just ranging every day. It was jittery. It was choppy. Do you remember that, guys? It was just horrible to trade, and that probably hit you even more, Huzefa, because probably being from the UK, you were looking at it like I was a lot more. And there were all these great strategies that work quite well on it, very technical strategies, and then they all just stopped working, and it was just miserable.
Two things kind of happened. It was like 18 months of just like the GBP USD was textbook trades, textbook triangle formations, continuation patterns.
The triangles, they were great.
It came right out of like John J. Murphy's book. Like you could have just copied and pasted those patterns over, and you just see the most incredible, like just double bottoms. You could explain it to a child. And one of the things that did happen, which is a good thing when it dissipated, is that there was a period when brokers stopped being just Forex brokers. Everyone became a multi-asset broker. And I think that really helped. So it's helped to unpack or untether people from just being a Forex broker. I can't imagine. I would never tell somebody today, as much as I enjoy Forex, to be a Forex trader, period, unless they have a very specific strategy on a very specific pair.
Yeah.
And even then, agree. Yeah.
So this brings us pretty nicely onto the US dollar, I think, which for our listeners, I should remind you, the biggest market in the world, Forex, $4 trillion a day, and the US dollar accounts for more than half of that. And the US dollar trends or has trended more reliably than any other currency. It drives the market usually more than any other currency. And when you get very decisive movements, they're usually US dollar driven. And we've alluded to so far in this podcast a couple of times about the US dollar bottoming out. And it started coming up again. It's moving to start to look like it's in a bullish trend. I'm long of the US dollar in one currency pair against the yen, though that's a bit systematic. That's not really like I'm picking everything. But Chris told me before the show that he is actually long of 12 he's long the US dollar against 12 currencies. And I'm not going to ask you to list them all, Chris, in case you forget some of them. But you said earlier, like you really saw that bottom and you decided to go for it. Is that what got you into those trades?
Honestly, what got me into that more than anything else, number one, things looked a little sluggish ahead going into it. And then when they cut rates and they said, yeah, maybe another one, but we're not entirely sure. I thought, okay, let's see how, and this was September meeting, let's see how the market reacts to this. And at the end of the day, there were reversal signals everywhere. So I shorted the Canadian dollar, I shorted the Swiss franc, I shorted the British pound, I shorted the euro. I was already long dollar yen for other reasons. Trying to think what else. I am short the dollar against the Mexican peso still. But that's the only place I'm short the dollar So now these are not huge positions. I don't want to make it sound like I've got 12 positions on and each one is 5% of my account or 7% of my account. It's nothing like that. I tend to build swing positions. So these are positions that if they work, they might last a year. Also, I like the interest rate differential, despite the fact that the Fed has been cutting. The bond market doesn't seem to want to go along with that necessarily. So I think you're in a situation where the dollar is going to continue to strengthen. There is a dollar shortage, despite Chairman Powell, Printer, Burr, everything else, all the memes you see. Countries like Canada, in the midst of a trade war, issued a bunch of debt, the largest amount of debt they ever had, denominated in US dollars. So things like that demand more US dollars. We actually have a dollar shortage. Most people don't understand that unless you understand the Eurodollar system. An Israeli shekel, a euro, Canadian dollar, Japanese yen, they're all derivatives of the US dollar. And when there's a lot of debt, that means there's need for a lot of dollars. If I buy a bond from the good folks in Ottawa, unless I'm willing to take Canadian dollars, really the only other thing that's viable is the US dollar. It lubricates the entire financial system. And with all of this debt and everybody issuing tons more debt, that's going to drive up dollar demand. There's also stable coins, I think, are going to be part of the mix for US dollar demand going forward, because they are denominated in US dollars, and the US has a huge jump on that. That could change down the road. Tether, what is that? USDC, Circle, like everything is denominated in US dollars, because I think a lot of people don't understand, that I talk to at least, people who have money, much more money than the three of us. If you have $200 billion that you have to sock away somewhere, I saw somebody giving Berkshire Hathaway grief about this. There's something like $540 billion that they have put into the treasury market. They aren't putting it into the treasury market because they think that's a great bet. They're putting it into the treasury market because your FDIC insurance for your checking account won't cover $540 billion. There's really only one place you can put that kind of money. Now, Huzefa, he may have $500 billion. I don't know. But where are you going to put it? You're not going to go to like HSBC and say, I'd like to open up a Christmas savings account. The reality is that treasury market drives the US dollar. Yes, the purchasing power goes down, but it goes down less than everything else. I mean, they're all bad at the end of the day. When you make a Forex trade, you're like, okay, this currency's bad, but it's not as bad as this one. So that's the route I'm going. And I think the US dollar's got quite a bit further to go. Do I think it's going to wreck the financial system? No. But if you look at a long-term chart of the Dixie, we just bounced off the bottom of, I want to say 30 years or something to that effect.
It's pretty long term.
It's actually very, very range bound. If you zoom way out, there is a range that the Dixie tends to bounce. There's like 3 or 4 levels that it goes back and forth. But these are levels that people who make generational decisions probably pay attention to. That doesn't mean that the dollar goes straight up, but it does mean that the dollar does tend to, as soon as you hear the end is nigh, that's normally when it turns around, and that's what happened here.
We had a reader ask a listener last week. Do we think the dollar will keep going up even if the Fed doesn't isn't positive on rates, if the Fed does cut, doesn't hold? Do you think like a rate cut in December could shake this and get us back down into that bottom area again, or you think the
knee-jerk reaction down and then a bounce? Because then people are going to be worried about, so is the economy worse than we thought? Then they buy treasuries.
The last time the dollar was as low as it was, when it bounced down, it was 2021. It was just a few years ago, and it's made that range has been. It took about 4 months to develop this kind of base pattern. That's why I think there's going to be a good 3 to 6 month trend off the back of that.
I agree.
When these bases, whether it's a topping formation or a base, it takes 3, 6, 8 months to form. Yeah. It produces, you're looking at a really strong institutional sentiment that's developed. Whatever the fundamentals are behind that, that sentiment has developed. It's printed in the market over that period of time. It's going to take a while for it to wash out. So you can really start placing trades off the back of that kind of formation.
Right.
And
So
I think a lot of the traders that we deal with on a daily basis, your trader that has 2 or 3 years experience reaches out to us. I don't think they realize that these institutional players that are involved, they matter. And in fact, they're the only thing that matters if you zoom out. They are looking at the dollar in terms of a few years. You can't, again, it goes back to size. If you have $500 billion under management, you don't just throw it into the market. You don't start pressing buttons. So that's those accumulation patterns. He's right. It means a lot, because that means a lot of people with a lot of big chunks of money are kind of coming in and accumulating. The old Dow Jones theory, the accumulation distribution, there's a reason for that. So I agree 100%. I think the dollar, it'll have its pullbacks, but I think it's going up 6 months, a year, maybe even 2 years. Forex tends to like to move in like 2 to 3 year cycles anyways, so it would just jive well with everything we typically see.
And it had its nice 2 to 3 year bear run on the way down.
Yeah, sure did. So a couple of weeks ago, when it was just Chris and I on, we were talking about gold and silver and how we had this incredible bull run and then it just blew up as we all knew it would. And Chris was saying to me, it did make me laugh. And we're not the first people to talk about this. Chris was saying he was out and he heard people saying, I've got to go buy some silver on Monday. And that was how he knew it was time to sell. When you hear people in the street talking about getting into the market, it's dangerously late in the trend. And Chris was saying to me, we should really talk about how this is an excellent leading sell signal or a signal to get out of the trend. It's kind of humorous, but you can actually do this. I mean, you could probably even do it using AI to like monitor social media. I don't know if there's any like retail tools, but Chris, you really heard someone saying that. You're not just making it up. You were actually out.
The story was my wife and I were going on this nature hike to see ruins of like an old pioneer village that's normally blocked off in a metro park. So we're there with a group of about 20 people, and I heard 3 different people talk about going to a bullion shop to go buy silver. And I've only heard that a couple times in the past. The one that really sticks out in my mind was I was in a Bob Evans, it's a restaurant. An older guy behind me, probably in his mid-70s, was talking about taking out some of his portfolio and buying this Bitcoin thing. And that was right around when they opened up the futures contract at about 20 grand. I think the second or third day the futures contract existed, I shorted it, made a ton of money, because the key here isn't just social media, because there are people on social media that will say gold's going to the moon every day.
I was thinking more about the frequency of,
right,
posts.
the frequency, but especially when you see people who have never opened up a Thinkorswim platform or a MetaTrader 4, when they say it, that's it.
The metric I first read was when your barber starts talking about it and when you start hearing it at cocktail parties.
There's a magazine too.
Yeah.
What's the magazine? Is it Barron's or
Barron's? I always think about the New York Times of all places. I think the New York Times is a fantastic lagging indicator. Like if they can find a way
in so many ways,
yeah. If TradingView could find a way of turning that into a number and plotting it on the chart, like how many times New York Times mentions something as a contrarian indicator, I think there's money in that.
I worry about some of the younger traders because it's very easy to get sucked into the idea, to get into the hype. And just a couple days ago on X, we're starting to see people post pictures of their desks that they've destroyed because crypto has fallen apart. But if you look at a chart, it really hasn't. okay, we're down 12,000 or whatever, maybe 15,000 in Bitcoin, but unless you're levered to
Yeah.
your chin, it's, if you got in it 2 years ago, I mean, you don't like it being down, but it's not the end of your world.
Because
And
people
I
get
worry about
messianic
these
about
small
it.
guys. Yeah,
They're
I worry about
messianic.
these small guys getting into the whole thing of silver's going to $200 an ounce. That's the other thing too. When you start hearing ridiculous numbers, that's a good sign.
Every generation has this like washout. Every generation has this wake up to reality moment, whatever the asset class is, whether it's equities, whether it's some kind of derivatives. It was options back in the day. Now it's metals. There was crypto for a bit. It was forex for a while. Every young generation has that moment where a market dips that felt invincible, and then they realize, oh, risk is real.
Nvidia.
Yeah.
Nvidia will be someday. And then once it's literally stock certificate can double as something to pick up your dog's mess, that's when I'm going to start buying Nvidia hand over fist. Because that's the thing. The AI, once it pops, it's going to be, to me, it's going to be like the old tech stocks. There was a point where you could have bought Amazon for a few dollars. There was a point where you could have bought Bitcoin for $3,000 after crashing. So
there is
you have
one
to
thing.
recognize these things.
Sorry, Chris. Didn't mean to interrupt.
No,
you.
you're
Sorry
fine.
about
You're
that.
fine.
There is one thing I'd say about young traders is they've got a better handle on. I'll speak for myself. Someone like me is that there's a core group of young traders who really understand how to use platforms like StockTwit and Reddit, etc., and how to pick up on stories a lot earlier. And follow that trend. If they're disciplined in their approach, they're disciplined in terms of their strategy, their entry, they understand that there is risk, they understand how to control position size, etc. They can really use that to their advantage.
Yeah.
No, it was a little more wild when Adam and I started. We had Forex Factory and that was it, basically, right? You had the news calendar of Forex Factory and you would just YOLO every announcement. Everybody was about non-farm payroll. It's our Super Bowl once a month.
Join us live while we trade the non-farm payroll. Yeah.
Right.
Goodness. You're bringing back memories.
Yeah. That was actually running for quite a while. But anyway, we're running a little bit late. So I do want to wrap things up into our last item, which is the only thing we're going to talk about that really isn't topical at all. And talking of Forex Factory, it's actually one of the strategy threads on Forex Factory. I know, it's funny. I have to admit, I still do look at Forex Factory because
I have one that has like 4 million views, but I won't say its name because it's just basic technical analysis at this point.
You've got a post up there that's
it's got about 4 million views.
Okay, I'm not going to ask what your hand was. I'm going to enjoy trying to find it and working out, guessing that it's you. There's someone, a poster called Too Slow, and he posted a strategy years ago, but I thought it's very simple and it doesn't make any big claims. There's no indicators. And the strategy basically goes like this. And I'm talking about because I back tested it and I did find on the Euro US dollar, it does have an edge. So you start about the time of the New York Open and you draw a line, you draw horizontal lines, the lowest hourly open since the Tokyo Open. So you've got like about, 15 hours or something. And then you draw a line at the highest hourly open. And you wait for the price to pierce one of those lines, make like a new high, and then come back. And the candle's got to close like up in the other direction. So basically, it's kind of like a failed breakout of the daily range on that calendar day. And I thought I would back test it. Oh, and there's one more filter. You shouldn't go long below yesterday's low, below yesterday's low, or short above yesterday's high. So you're kind of in line with the 2-day trend. And I tested. I thought, the Euro US dollar, it's cheap, so low spread. So, and it does tend to range a lot and have a lot of failed breakouts and deep pullbacks. So the way I back tested it was I just checked just at that time of the New York Open. And I found out that if you divide the average maximum favorable over the next few hours by the maximum unfavorable excursion in the trade, you've got an edge of about 6 or 7%. in the like 2, 3, 4 hours just after that. And I did it partly on the New York Open because that was the strategy, but I only tested that out because I've noticed that you often get these big reversals in the Forex market just around the time New York opens. So I guess like I'm thinking 6%, is that really a good edge? You know, some people want to see like 15% on a systematic back test. Chris, we were talking about this before we started recording, and you mentioned that you thought this would be interesting during the summer. I didn't test it with seasonality, but you see the summer as a time when the Forex market's likely to range.
I could do you one better, actually. I bet you could extrapolate this out to something along the lines of CFDs in indices in the summer, or just pay attention to the VIX. If the VIX is extraordinarily low, I bet it has a higher win rate. That's without me backtesting. Full disclosure, I've not seen this system, so but it sounds to me, I mean, it almost sounds like the opposite of an opening range break in the futures market. So the first 30 minutes, once you break above the top of it, you're long. It almost
exactly
sounds like the exact
is.
opposite of
You're
it.
fading it.
Yeah.
Yeah.
Fading breakouts can be a good strategy in Forex. I mean, if there's any asset class that tends not to break out, I guess it would be Forex. You know, although you do get good breakouts, the trick is to learn how to differentiate them. But I've seen failed breakouts in the Eurodollar that are just wonderful, wonderful trades. Some of the best trades you'll ever see. When everyone's looking for a breakout and it fails spectacularly with a really big reversal candle, that can be a time to get in and really realize that the smart money took the breakout money and is using it as fuel to send that price flying in the other direction.
6% for a pretty mechanical strategy. I'm guessing that's what it is. You and I traded that strategy. We should get identical entries and exits, right?
Yeah, you could obviously finesse it, but I just did a kind of Excel sort of back test without doing
for a pretty mechanical strategy. 6%, it's not bad for something that requires not much thought. Somebody could get their heads into. What I'd be interested in seeing is how long and how deep are the drawdowns. How long does it take to recover and that kind of thing? But like,
I think I tested it in chunks of like two or 3 years, and I think there was only one or maybe 2-year periods since 2009 where it came out behind.
Okay.
So, that's not bad, and I can't remember how many trades there were. By the way, I was only checking it when there was a failed breakout just in that first hour after New York opened.
Right.
I seem to remember that Too Slow, the guy who actually put the strategy up, said you can do it for about 3 or 4 hours after New York opens.
It sounds like the kind of strategy that it could be part of someone's toolkit, but I wouldn't rely on it.
Yeah, I agree.
Yeah, because sometimes, again, you get lucky. When I shorted the pound dollar, there's nothing to do but let it work for you. Why get out? But I think Huzefa's right. I think it could be something that you could use as part of what you do. We've all done this, I'm sure. I have a couple long-term trades going, but every once in a while, go, oh, look, gold just broke that. Press the button and you're out 10 minutes later, despite the fact that the rest of your account has positions that have been open for 7 days or whatever. You might be able to use it for, like, I would almost think of that as like a bonus, an addition to my core strategy. Now, again, I spend all day looking at the charts. I don't spend all day trading. So I think it would be an opportunistic thing. I'm sure you could automate it.
Yeah.
And like using Python, you might be able to do something like that. But I don't know. 6% edge, that's not bad over time. I mean, like you said, it could be part of what you do. Nobody, you're not going to get your Lambo and your Gulfstream 5, your house in the Hollywood Hills using it. But if you do that in addition to interest rate differential, longer term trends like in the S&P 500 or whatever.
Yeah.
I mean, it's part of what you're doing, and that's good.
Yeah.
You won't find too many mechanical strategies that over a period of 15 years you can backtest.
Continue to work. Yeah.
That in and of itself is kind of impressive.
Yeah. Given how much the markets have changed in terms of personality, and what Chris alluded to before about algo
they
trading
really have.
entering and just like,
True. So I've got to wrap up now this bumper edition of Pairs of Aces, but it has been a pleasure. This has been our best episode yet, I think. I've got to thank you guys very much for joining us today. It's three's a company, two's a crowd, or I'm badly mixing my metaphors now as I search my brain for a suitable outro. But I do want to say, please do subscribe. We want to see you guys back for episode number 5 next week. You leave comments, leave questions in the comments, and we will answer them. And I look forward to seeing you all next week. Huzefa, Chris,
Thanks, man.
a pleasure.
absolute pleasure. Thank you,
Have a
guys.
good one.
Thank you, guys. Bye-bye to all. And remember, if you liked and enjoyed our episode of Pairs of Aces, you can subscribe to DailyForex's YouTube channel. Please add your questions for the next episode in the comments below.